This is Alternative Angles, the Fidelity podcast, where we hear from investors about complex strategies outside the realm of conventional stocks and bonds. I'm Steve Rosen, and I'm your host. I recently came across an old movie poster from Back to the Future, which gave us an entertaining take on finding a solution by going back in time. And then, as I was thinking about this episode on direct lending, it struck me that reaching back to yesteryear may answer the question as to where the market still offers an edge for investors. In the bygone days of the 1980s and 90s, traditional middle market commercial finance companies were the dominant sources of capital to small and mid-sized businesses. Firms like Heller Financial, CIT Group, and GE Capital delivered customer service-oriented solutions by developing special relationships with their borrowers and specialized knowledge about their industries, and then creatively structuring loans with underwriting discipline and covenant protection. Those firms were eventually supplanted by the private credit industry, which has matured into what's now a global institutional asset class. And with the growth has come capital concentration in the most scalable parts of the market. For allocators, that creates a central question. Amidst this increasing competition, can managers preserve an advantage, or is the market becoming commoditized? One answer may lie in revisiting the archetype of the traditional middle market lender. And today we will do just that with our guest, David Gaito, Fidelity's head of direct lending. Upon joining Fidelity 5 years ago to build its platform from the ground up, David decided not to compete in the most crowded segment of the market. Rather, he opted to emulate a traditional middle market approach while integrating that model with the resources, sourcing breadth, and infrastructure offered by his new firm. In this discussion, we will examine, among many things, where market inefficiencies persist, what separates durable lenders from cycle beneficiaries, and whether scale in private credit enhances manager advantage or gradually arbitrages it away. David, welcome to Alternative Angles. It's great to see you.
Thank you, Steve. Great to see you as well. Happy to be here.
Yeah, it's good to have you back. So to start us off, I want to jump right in and ask you, thinking retrospectively, as you were coming to Fidelity 5 years ago, and by the way, congratulations on your recent anniversary of 5 years here.
Thank you.
You're coming here to set up this business. Tell me, what was the original thesis about the market or the opportunity and the platform you set out to build?
Well, Steve, the original thesis was quite simple, and I'm glad that Fidelity bought in. I know you know Harley Lank, the head of high income and alts, and worked with him for a long time. And my message to him in one of our last meetings was, if you want to go head to head with the upper mid market lenders that exist, large asset managers in that space, that might be the right thing for Fidelity to do, but I think it'd be a mistake. And he said, why? Why would that be a mistake? That seems like the easiest segment to build a business in for Fidelity. So it's a mistake because they have large entrenched competitors, and if you're winning against them out of the gate, you're probably doing something you shouldn't be doing, and that's the recipe for a failed direct lending business. And I said, secondarily, there's a trend. These folks mostly started in the traditional mid-market, i.e., they lent to a smaller business. You had upper, lower, and core 10 years ago, but that band was under 50 total, right? You'd be an under 10 for lower, 10 to 25 or so for core, and 25 to 50 for upper. Now that band is dramatic, right? The top 10 asset managers in terms of AUM, they average about 250 million of EBITDA. That's a big company, right? And that trend was already evident 5 years ago. And they not only grew, they left the traditional mid-market. At the same time, it was becoming more and more evident that scale really matters in this business. Half of your capital is typically from leverage providers, and so scale there is easy to see. But broadly speaking, the ability to consistently raise capital, institutional investors wanting you to be more than just a direct lender, right? Private equity firms wanting you to be more than just a direct lender were evident. And so you already started to see the acquisition wave, the traditional mid-market firms being sold to others in the hopes to garner sale. And I thought two things. I thought Fidelity was a brand that even without those dynamics could be strong in the traditional mid-market because it's a segment that really values trust and endurance and cycles. And if you think about our firm, right, we've been in the high income credit space since the late 70s and are one of the most trusted names in the market. But I also, more importantly, thought it was an opportunity for someone like Fidelity with their scale and brand power to take on that vacuum and be a leading lender in the traditional mid-market. And, so that's the original thesis.
Okay. And as you look back, has anything changed from that original thesis?
No, I think it's actually gotten stronger, right? I think when you take a step back in look, the media headlines today are awful, right? They're not good. And, the truth that lies in them is that there's been a lot of growth in this asset class, right? And the majority of that growth has occurred in the upper mid market. And, we'd argue that you now have two different classes of direct lenders, right? You have a traditional direct lender that is a time-tested strategy, as you mentioned in your opener, right? Heller Financial, I'm in Chicago. We're building the business in Chicago. Heller was in Chicago a long time ago. I know your roots are there, which made me smile when we were talking about that. They were doing middle market credit in the 80s. So we view that as a time-tested strategy. And in the upper mid-market, those firms are making a bet that bigger is better, right? And they're giving them structures that largely existed in the broadly syndicated loan market. And I think the media, investors, et cetera, are questioning that, and rightfully so, as there hasn't been a long enough time period of that sort of investing to say that it's a time-tested strategy.
Okay. And you just talked about how, bigger is better in the minds of some. So when you talk to prospects for your business, what distinctions do you want them, most to understand between what you're doing and perhaps what they're reading about it?
I think competitors use bigger because it's easy to understand, right? A bigger company should be more secure from a lending perspective. And if that's the only variable, that's likely true. I say likely because it might not be. There are big companies that don't have a moat. There are big companies that could go away tomorrow. But by and large, if you can lend to a larger company, you could have more ways to get out of investment. But the reality is a lot more nuanced than that. How much leverage are you providing? Right? Because leverage is the number one killer of businesses, not company size. And what we've seen, in the last 5 years is ever increasing amounts of leverage in the upper mid market, often starting at 6, 7 times. That increases business risk materially. We've seen structural degradation over the last 10 years, right? There's a lot in the news about Cov Light and pick, good pick, bad pick. I don't think there's a such thing as good pick, right? And quite frankly, if you in your Heller days, if you think back, if you went into an investment committee and said, I've got this great middle market credit deal for you, the one catch is we're going to have to be covenant light and we're going to have to offer them pick out of the gate for a first lien senior secured loan. You might not even have made it back to your desk. And if you did, you'd have definitely had a pink slip and a note from HR that said, this wasn't going to work out. And you laugh hard about that. But today, you're hearing good pick in Cov Light. And a lot of folks don't realize, it wasn't until about 2015 when the broadly syndicated loan market was majority Cov Light. Today it's 90%, and it's kind of a foregone conclusion. But, the broadly syndicated loan market didn't start to see Cov Light loans until 2010, 2011. And, the upper mid market with some of the capital being raised progressively started to do that late in the last decade and even more so this decade. And so these are newer conventions in a privately held company and a privately negotiated loan that you can't trade out of. And I think one of the things that we've done a really poor job of in the industry is making sure everyone knows we're fallible. We're not going to be perfect, right? We're going to make bad loans. In a scaled business, it's almost impossible not to do so. And so for us, when we think about the upper versus the traditional side, that covenant is invaluable for protecting your downside for when you do make a mistake. And it does two things, right? It gives you the ability to reprice the risk. Your risk is clearly changed if someone's broken a covenant. And so it gives you the ability to change that return profile. Most importantly, though, because this is about getting your principal back, not charging more on something that you're never going to receive. And you get a chance to protect the capital base, re-underwrite the credit, right? The company's broken a covenant and your underwriting's clearly off. And so now it's, what did I miss? Or maybe I didn't miss something. Maybe something occurred. And how do I assess that risk? Is the owner going to be supportive? We work with private equity firms on the majority of what we do. And it's not because we expect them to put good money after bad. It's firms we've worked with before. They tend to do the right thing. That might be a management change. That might be adding more resources. That might be adding a consultant to understand, what's going wrong. And that's powerful. If you don't have a covenant, right? I know a lot of folks will say it's a relationship business and you can lean on the sponsor. Maybe if it's a normal time, you can. Maybe if it's a dislocation, that's just not ever going to happen. And either way, they don't have to do anything. When you have a covenant, they have to do something. So I think it's a material difference. And, lastly, and I think most importantly, because we're in the investment business, we've done a lot of work around returns and dispersion over time, net of loss returns. And our research tells us that not only are the returns higher in companies with less than $30 million, net of losses over a 10-year period, but the dispersion's tighter, much tighter. It's, mid 700s basis points versus nearly 1,200 for the upper mid market. If bigger were better, that would never occur. You'd have a tighter band of dispersion in the upper mid market, and the returns net of losses would be better.
Interesting. I think we'll maybe talk a little bit more later about covenant protections and how they've waxed and waned. But before we get there, I just want to go back to your origin story. We both referenced it, and to me, one of the interesting parts is that you built the business inside this very large institution. And so, can you walk us through that achievement and explain the triumphs and also the challenges?
Well, I think triumph's a strong word. It might be too early to run a victory lap here.
Okay, fair enough. How about what's worked out nicely for you so far?
Yeah, we're off to a very good start, and right. And I think the amazing thing about Fidelity, and the thing that struck me most, and I say this often, my first day in the role, April of 21, I get a call from the head of asset management, Bart Grenier. And his words to me are, David, don't ever do an investment to deploy, right? That's called deployment. We invest here. Everything you do, make sure it's backing good investments that you're proud of. And if you do that, we'll be one of the largest direct lenders someday. And that's how we think here. We think in decades, not days. And so everything we've done at the outset has been with that lens in mind. And when I think of achievements, I think of we are part of a $7 trillion organization, and the organization is really excited about building this the right way in the marketplace. And when you can harness that power within Fidelity, the world's kind of your oyster. And so when I think of the largest achievement, it's that a business didn't exist in 21. And I mean, no systems, and no funding sources. We built revolving capabilities, which is operationally intensive, and, whiteboard upon whiteboard to understand how we get from not existing to launch. And we did that within 6 months. We had operational capabilities in October, early November of 21, and made our first investments in December of 21. I remember on my Zoom screens, because we're still in the COVID era at that point, right? Everyone's on Zoom. No one's really in the office. I had 10 teams with 10 plus people on a screen. Hollywood Squares didn't stand a chance against this. And everyone on that call was dead set that we were going to launch that year. And what that did for us is it allowed us to start investing in a time that was a little more aggressive, because everyone asked, well, isn't this the wrong time to start a business? And I laughed and I said, I don't, is there a right time to start a business? Right. And so for me, I've always looked at it as, whenever you're ready is the right time. And it set us up to take advantage of the dislocation in 2022, where we went from being a new entrant to relying on our team's history, which we've got a very experienced team, right? Our investment committee averages over 25 years in this business. Most of the folks we have been in this business for a long time. Allowed us to use those relationships and really show the power of Fidelity at an early stage. We had something like 250 million in a portfolio in August of 22. We went into 23 with $1.5 billion because we thought that was a very attractive time to invest. On the challenges side, too many to list, but quite frankly, not material. Right? You have to take the right mindset, and being entrepreneurial and starting a new business isn't easy, right? It's part of the thing that excited me. And I think you can't take any challenge as anything more of an obstacle that you have to understand and structure around, whether it's internal or external. But by and large, the institution has a terrific amount of talent that's very excited and has continued to grow around this business. And if there's one thing that you can just check off to hit it again, it's we've got a lot of firepower that's excited to build a world-class direct lending business in this organization.
Yeah, for sure. Now, edge is a word often tossed around in the investing industry. And so I'm curious, among factors such as deal sourcing, underwriting, structuring, portfolio construction, asset management, where does your edge show up? And then amongst, those elements, what are you still striving to improve?
Well, we strive to improve every day, constant improvement. And look, I think a lot of my fundamental beliefs, our team's fundamental beliefs are hallmarks of Fidelity, right? Don't be complacent. Always look to improve. Overall, I think we have an edge everywhere it matters. And I know I'm biased when I say this, but let's start out with one of the most critical edges you can have: talent. We're a people business. If you don't have the right people, you lose. Whether you lose because you can't originate a deal or you originate the wrong credits, right? Both are bad. But we've been able to attract high quality talent consistently in our early days in highly competitive markets. Even today, where there's a bit of dislocation in the private credit space, and we get a lot of inbounds with high quality talent. We have a scale advantage where we tapped into the internship program a couple of years ago. We have a world-class internship program. It is harder to get an internship in Fidelity's asset management platform than it is to get in Harvard. Think about that. Right. And so we get high quality talent. We have 6 interns come in the summer. It's grown every year. We hire the best out of that group. Just because you got an internship with us doesn't mean, we're going to hire you, but it does mean you get a real look. 2-3 months, we put you on real deal teams and we get to see, A, are you capable? B, do you have the culture fit that we expect? And C, importantly, do you like this? Right? Do you want to do this? Because this is a different business. We have another program that has college graduates that we tapped into last year called the Executive Leadership Program. This hires from similar schools, but they're liberal arts majors. And we found this gives us, not only diversity of schools and people, but of kind of experience in undergraduate. And so talent is a big edge. So once you get the deal, because I think origination is something folks throw out, and I think everyone thinks you need a sales team, right? You need someone to sell, and I've never been a believer in that. I believe consistently, and I think this is a Fidelity staple as well, that you can be two things. You can be market, you can be cheap and easy, or you can sell execution. And that's what we try to do. And so we've got a team, we've built a team with a track record in middle market credit that, most people have, 15 to 25 plus years in the business. And we've worked with firms that we respect, right? We work with sponsors that buy companies we like, that tend to treat us like a partner. And when we work together on a business that misses its mark out of the gate, they try to fix it, right? And we thought that the Fidelity brand in that space in particular could be very powerful. Because when you think about the marketplace, you have private equity-backed direct lenders. I don't necessarily think the world needs another private equity-backed direct lender. No offense to anyone in that business. And then you have the other side, the only direct lenders. And I think that's a pretty lonely space, right? If you're only a direct lender, what else can you provide that company? And what we're building is a firm that can get excited about a sub 30 EBITDA business and lead that credit, as well as help that same firm, maybe that company, if it grows enough, execute in the broadly syndicated loan market, high yield markets, and if they're really successful, like the IPO market. We're one of the largest buyers of IPOs in the world, and bring that scale to a private company, which we think is unique in the market. Underwriting. We have nearly 500 research associates. We built this business in asset management, by the way. I don't know if I said that earlier. I think that's a powerful edge. We have full access to the platform. Every research report that's written in asset management, whether it's equity, investment grade, or high income, high yield, leveraged loan team, we have access to, we receive. And, that is a powerful edge. That's the easy button for us. Our teams are integrated. Just last week we got a call. We have some flexible packaging businesses, and our team in the high income side was visiting a $9 billion manufacturer, and our team was on the ground with them, seeing what best in class looks like, so we can take that and extrapolate that to our middle market credits. The thing that you don't see, and the thing that quite frankly I was very naive to, is the real power of scale, right? Software is in the news a lot right now. We outsource to over 1,000 B2B software firms. My team talks to our procurement team on any B2B software investment we look to make. We get real buyer information. They tell us in an unbiased fashion, is it truly mission critical or not? Have you looked at these types of names? We might not give them our name, but we ask them a broad range of names and ask them why they did or didn't, to see if this is truly something we should invest in. And there are businesses like this throughout, whether it's real estate, financial services, we custody and clear for something like 10% of the registered investment advisors in America. We're the backbone. And so there are spaces that we know extraordinarily well. And our team uses that to our advantage. And then data, AI, et cetera, when you think about who we are as a firm, they're major competitive advantages. Management teams, right? You might work with private equity firms and get a look, but you want to get management team buy-in. And management teams know us. When you think about the direct lending space, even the larger asset managers, they might be well known in our ecosystem, but if you go throughout America, management teams might not know them. We have a relationship, we being Fidelity, with 1 in 4 families in America. Our name resonates, right, with those management teams, and it allows us a much more comfortable process. Many times we're working with a management team that is getting sold, right? They're part of an acquisition. This is a big, transition in their lives, and we provide them, with some comfort. And then lastly, with investors, we get a lot of meetings because our brand is Fidelity, and people are interested in understanding who we are, and capital base is important. And then that's supercharged on the leverage front. Most of our strategies are leverage strategies, typically 1-to-1 plus or minus. And we are one of the largest counterparties to almost every major bank in America. And that is powerful for us when we're on the ground. When you think of what we bring, to our investors, when we launched our perpetual BDC 3 years ago, we launched it on 03/13/23. Right? It was a Monday. The Friday preceding it, Silicon Valley Bank collapsed. We closed a $500 million revolver with a syndicate of 10 banks, which at the time was market leading pricing. Only two other asset managers, to our knowledge, had pricing that was similar. And when you think about what that brings to our investors, it's super powerful. So I look at our edge, as a full circle around everything that matters in direct lending. And I think it's really powerful.
Yes, certainly. I agree. Sounds very compelling. Now, moving to a different topic, there are just a few asset classes for which the year of origination or vintage matters. And direct lending strikes me as one of them. And I'm, curious, to what degree does, vintage matter to investor outcomes in your opinion? And over time, how do you steer through that opportunity set?
That's an interesting question, Steve, because I think fundamentally, I believe that direct lending is an all-weather asset class, which means vintage shouldn't matter. And I say shouldn't because, I'm a big believer there are no absolutes. But if you take a step back, fundamentally, I like to say we're a spread business and we're, 5 to 7% over floating rate SOFR in all markets. It should average out around 6. And I believe that's largely the case. Of course, you'll go a little below that 5 and a little above the 7. And those are the two markets that matter. And the dislocations are a period where vintage could matter to the upside. It's one of the times where you might be able to generate even more alpha and credit, where you can get much higher spreads than you should garner and much tighter structures than you should garner. And we saw that in 22 and 23. The second is when you have really aggressive markets and you aren't disciplined in those markets. And that's where vintage could matter. And I think 2021 is an interesting case of that. You had several forces collide at the same time to create one of the most robust M&A markets and one of the most aggressive M&A markets that we've seen in our history. And the forces are extraordinary private equity fundraising the prior 5 years, especially in software. Software fundraising the 5 years preceding 2022 is extraordinary relative to the 5 years prior. And extraordinary private credit direct lending fundraising at the same time. And that followed COVID, where a lot of managers point to COVID as being the test for the asset class. I look at it as certainly a painful period, but it was short. It was more like a pop quiz. And the government, governments around the world pumped the economy with so much stimulus that I think a lot of lenders kind of beat their chest and said it was me that got through this and not the reality that was many factors outside of their control. And you had a lot of companies that came out to the market and you saw a very, very aggressive market. And I think that vintage is going to matter. And I think that this year is going to be an interesting year, the way it's playing out, because the past 2 years we came into the market and we thought we're going to have a good M&A market. M&A has been down. You don't need a strong M&A market to have a good year, but it helps, right? M&A markets, broad M&A markets can help a good amount of activity. And I think a lot of the headlines that you're seeing are derivatives was that 2021 vintage a little too aggressive and will it have consequences? I suspect the firms that have had discipline, in that market, especially on the traditional side, when you have covenants, you get a chance to course correct. I suspect, they'll be fine. I think this is where the upper mid market, especially, is going to be tested. And if 2026 turns out to be as strong as an economy as it appears to be still, it'll be a slow burn and you'll be able to work through that. Good economy cures a lot in credit. If the economy for some reason goes sideways, I think it could be a really bumpy market because what happened during 21 largely was a lot higher leverage than historical standards. And that structural aggression was most prevalent in that time. And you're going to be working with companies that were financed in a regime of zero rates, thinking they were going to be low forever, and an inflationary environment that was transitory that turned out not to be the case. And that's a tough combo to recover from. especially if you're 4 or 5 years in and you haven't seen growth and you haven't seen some of the adjustment expectations you expected to occur.
Okay. Now, you mentioned some of the good times and some of the more challenging ones for the market. And over the last number of months, private credit, certainly has been in the headlines as investors have withdrawn equity capital. I'm curious, what are your sources of equity, and to what degree has your business been impacted?
Well, it's mostly been impacted in the sense that it's just harder to raise capital, right? And it's hard to raise capital generally, but it's become a lot more challenging in the past 2 years. When I think about capital, I think about it like credit. You want diversity. And so we actually have a very diversified capital base that's intentional because one day you might have a lot of excitement in a certain channel, and the next you might have folks that are pulling back and being risk off. And so I'll take you through sequentially what we've done. Our first investment vehicle is a private BDC. Fidelity portfolio managers have access to commit funds to that business. It's about 20% of our capital base. When I was doing the internal road shows, a team of portfolio managers came to me and said, "This sounds very interesting to us. We'd like to put a small percentage in," and they've been good partners, and the vehicles perform very well, I think, for them. We've been one of the top performers for their funds. The second is a perpetual BDC, which is getting a lot of news in the headlines. I'd like to point out for listeners, if you actually take a look at direct lending, these perpetual BDCs are only 20% of the market. And, with 5% redemptions a quarter, you're talking 1% of the market a quarter at risk. And so I think the headlines are sensationalized in a meaningful way relative to the impact of the market. The rest of the market, 80% of it, is longer term locked up capital, whether it's a public BDC or the lion's share, which are institutional vehicles, which are longer term lockup. And the investors get liquidity when you get loan refinances. Nonetheless, we have one of these vehicles. We launched in 23. I mentioned that earlier. That's about a 25-30% of our capital. We have investors from the Fidelity Green Branch system in there, as well as RIAs that we partner with throughout our ecosystem, custody and clear with largely. That's been a consistent grower. It's certainly slowed in 2026, and I suspect 2026 will be a slower growth year, and that's fine. We're not in a race. We're building that vehicle to be an income strategy for our investors, and to date, we've delivered on it. We've delivered a lot of income back to the investors, and we think over time we can be a winner in that vehicle environment. I think the Fidelity ecosystem rewards 3, 5, 10-year performance and looks less at quarterly and annually. And so our first 3 years with that vehicle has been pretty positive. The third vehicle we launched was a levered institutional vehicle where we closed in a first close in 2024, a little over $1 billion of institutional equity capital. I think 4 endowments, a couple Ivy League in there, 6 insurance companies, several that have been in the business for a long time, the direct lending business for a long time. We had a large private market consultant invest directly and advise a public pension to invest. We got a family office and a corporate pension. That vehicle is about 20-25% of our capital. And this year we launched an unlevered strategy that's similar to that. And we're fundraising at the moment and off to a decent start. All the vehicles over time should look similar, right? These are all evergreen vehicles. And we invest pro rata based on buying power across it. And so we've got a fairly diverse capital base today, and our goal is to continue to grow that and constantly look at capital solutions so that our investors have diversity and our customers, the private equity firms and borrowers, know that we can be an all-weather investor. That's the only way you can do it, is if you have a diverse equity base to invest in all markets.
Okay, so that's the equity side of the business. And then, of course, there's the liability side, also very important. So, how resilient is that financing? And then, what happens under stress?
That's a really good question. And it's something that I think that's often overlooked. And so from the outset, we've looked to leverage Fidelity in this equation. And one of my first conversations with Harley Lang, the head of high income and alts, was which two or three lenders would would need to call the top of the house if they ever thought they needed to pull our lines, right? Which senior lender wouldn't look at us as Fidelity's direct lending business? They'd look at us as Fidelity. And that's where we started our search when we added leverage providers. And I think when you look across our vehicles, if we access leverage, a couple things you'll notice. We have multiple types of leverage, right? So there's just not one flavor. Again, because if that flavor is not working the right way, we want to make sure we still have access to leverage. The second part is probably central to your question, which is we tend to work with large counterparties of Fidelity that are also large and active as a direct lending back leverage provider. And you see that across. We have diversity in those firms. We have long relationships with those firms from Fidelity's perspective. We have open and honest dialogue with them, right? I think when you surprise a lender, it's not a good day. We're a lender ourselves, and we feel a little weird when we're negotiating on the other end, but we want to make sure we have enough flexibility. We want to make sure we have cost-effective leverage. And importantly, we want to make sure that our leverage withstands all markets, our leverage structures. And we got a guy, Hadi Hussein, who's the head of our alts financing. He's terrific. And, we have everything from the traditional asset-based, which has been in the news a lot. Some firms have the ability to mark assets down a bit. We have revolvers on our BDCs, which give us a lot of flexibility and low cost. We have unsecured financing and CLO financing. Your CLOs, a lot of times it's an AUM business for the broadly syndicated loan market, but in direct lending, it's used for leverage, really cost-effective leverage. So we look across the spectrum, variety of partners, to make sure that if something happens to that firm or that type of leverage, that we have full access to it, and that we're never reliant on any one lender, any one structure, or too close to the edge.
Okay. Well, we are getting close to time, and so I want to get closer to wrapping up. And to tie it all together, I'd like to ask, where do you think inefficiencies persist in the traditional middle market in which you're operating? And, which of those are structural enough to support excess return rather than simply inviting new competition?
Well, I think inefficiencies exist all throughout the traditional side of the business. And while there might be more lenders in total, the way firms access the market is very different. And I think fundamentally today, that's more true than ever. When someone looks for a direct loan, right, they might only call 3 or 5 of their direct lending partners. That's highly inefficient. They might get a decent price and a decent structure, but that's not the way the public markets work, as you know. I mean, all the big investment banks will call thousands of their best friends to get a read on what market is. That is truly an inefficient process. And that's the case today. I think there's a lot of uncertainty in the marketplace today, right? There was a period where dispersion was really tight in direct lending. And so it was very hard to differentiate who the better providers were. Today, that's not fully the case, but it's becoming much more clear as investors continue to report, and you're seeing a broader span of dispersion. And I think within that, that's where the better lenders will come out stronger. And that's where they'll benefit from an inefficiency of there's value in working with you, right? There's value in knowing that you've lent in all markets. There's value in knowing that your lenders and equity investors value you as a partner and you're growing through these times. And I think that will persist. And fundamentally, one of the biggest differences in what we do versus the public markets, and part of the premium is that front end, right? That ability to originate credit, the ability to understand that credit, and the ability to structure and price in all markets. And there's value in that to your counterparty. And the reason is quite simple. Most firms don't make money off of having the most efficient leverage. They make money off of buying the right company, growing it appropriately, and selling it for a lot more. And when you look at a return bridge at the end, debt savings is a small fraction. What matters to them, are you a constructive party that I know I can count on? And I think there's real value in that over time. And it's the value of the Fidelity franchise. If you think of the reason we've been a large investor in the high income space since the late 70s, it's because we've been around all markets. And we might have not have been the cheapest or loosest structurally in some of those, but we were there and we're willing to support it. And that's in order to our benefit of growth on that side of the business. And I think long term, if we execute the way we're intent on executing, we will deliver that value in the traditional mid-market, and that inefficiency will in order to the benefit of all of our investors.
Great. Well, David, I really appreciate you spending the time, great insights and perspective. And thanks for stopping into Alternative Angles.
Thank you, Steve. Really, really glad to spend some time with you today and appreciate being included.
This podcast is intended for institutional investor and investment professionals only. Information presented herein is for discussion and illustrative purposes only, and is not a recommendation or an offer or a solicitation to buy or sell any securities. Views expressed are as of June 2026, based on the information available at that time, and may change based on market and other conditions. Unless otherwise noted, the opinions provided are those of the speakers, and not necessarily those of Fidelity Investments or its affiliates. Fidelity does not assume any duty to update any of the information. Unless otherwise expressly disclosed to you in writing, the information provided in this material is for educational purposes only. Any viewpoints expressed by Fidelity are not intended to be used as a primary basis for your investment decisions and are based on facts and circumstances at the point in time they are made and are not particular to you. Accordingly, nothing in this material constitutes impartial investment advice or advice in a fiduciary capacity, as defined or under the Employee Retirement Income Security Act of 1974 or the Internal Revenue Code of 1986, both as amended. Fidelity and its representatives may have a conflict of interest in the products or services mentioned in this material because they have a financial interest in the products or services, and may receive compensation, directly or indirectly, in connection with the management, distribution, and/or servicing of these products or services, including Fidelity funds, certain third-party funds and products, and certain investment services. Before making any investment decisions, you should take into account all of the particular facts and circumstances of you or your client's individual situation and reach out to an investment professional, if applicable. References to specific companies or investment themes are for illustrative purposes only and should not be construed as recommendations or investment advice. Investment decisions should be based on an individual's own goals, time horizon, and tolerance for risk. The securities mentioned are for illustrative purposes only and not necessarily current holdings invested by FMR LLC. References to specific issuers or securities should not be construed as recommendations or investment advice. This piece may contain assumptions that are forward-looking statements, which are based on certain assumptions of future events. Actual events are difficult to predict and may differ from those assumed. There can be no assurance that forward-looking statements will materialize or that actual returns or results will not be materially different from those described here. Alternative investments are investment products other than the traditional investments of stocks, bonds, mutual funds, or ETFs. Examples of alternative investments are limited partnerships, limited liability companies, hedge funds, private equity, private debt, commodities, real estate, and promissory notes. Some of the risks associated with alternative investments are alternative investments may be relatively illiquid. It may be difficult to determine the current market value of the asset. There may be limited historical risk and return data. A high degree of investment analysis may be required before buying. Costs of purchase and sale may be relatively high. Stock markets, especially foreign markets, are volatile and can decline significantly in response to adverse issuer, political, regulatory, market, or economic developments. Foreign securities are subject to interest rate, currency exchange rate, economic, and political risks. Securities selected using quantitative analysis can perform differently from the market as a whole as a result of the factors used in the analysis, the weight placed on each factor, and changes in the factor's historical trends. Securities lending involves the risk that the borrower may fail to return the securities loaned in a timely manner or at all. If the borrower defaults on its obligation to return the securities loaned because of insolvency or other reasons, a fund could experience delays and costs in recovering the securities loaned or in gaining access to the collateral. Past performance is no guarantee of future results. Investing involves risk, including risk of loss. Fidelity Investments provides investment products through Fidelity Distributors Company, LLC, clearing, custody, or other brokerage services through National Financial Services, LLC, or Fidelity Brokerage Services, LLC, members NYSE, SIPC, and institutional advisory services through Fidelity. Institutional Wealth Advisor, LLC. Copyright 2026 FMR LLC. All rights reserved.